The price-to-earnings ratio is a fundamental financial metric used by investors to assess the valuation of a stock. It's calculated by dividing the current market price of a stock by its earnings per share. The formula is P ratio is equals to stock price divided by earnings per share. Interpreting the P ratio is crucial for stock selection. Valuation. A low price to earnings P ratio typically suggests that a stock is potentially undervalued relative to its earnings, making it an attractive buy. Conversely, a high P ratio may indicate overvaluation, meaning investors are willing to pay a premium for future growth. The interpretation can vary by industry. Technology companies often have higher P ratios due to growth expectations, while utilities may have lower P ratios, reflecting stability and lower growth prospects. Market conditions, sentiment, and economic factors also influence how investors perceive P ratios. Growth expectations. A high price to earnings P ratio often implies that investors anticipate robust future earnings growth, willing to pay more for expected returns. It reflects optimism about a company's prospects. Conversely, a low P may indicate skepticism about growth, signaling that investors are cautious about a company's ability to increase earnings. P ratios serve as a gauge of market sentiment and expectations regarding a stock's growth potential. Risk assessment. A lower price to earnings P ratio may seem like a safer investment, suggesting less risk. However, it can also signify stagnation or declining earnings, which is a risk in itself. Investors should be cautious when interpreting low P ratios, as they could be due to fundamental issues within the company. It's essential to balance perceived safety with a thorough analysis of a company's financial health and growth prospects. How to compare with other stocks. When evaluating a company's price to earnings P ratio, it's crucial to consider industry and peer comparisons. A lower P than peers may indicate a potential bargain, but it could also reveal underlying problems or challenges specific to that company. A comprehensive analysis that incorporates industry dynamics and individual company performance is necessary to avoid making investment decisions solely based on relative PA ratios. Historical analysis. Examining a stock's historical price to earnings PI ratio provides valuable insights. A rising P over time suggests growing investor confidence in the company's future prospects. It may indicate improving financial performance, expansion plans, or a shift in market sentiment towards positivity. However, investors should also consider the reasons behind the trend and whether it aligns with the company's fundamentals and broader economic conditions to make informed decisions. Cautions to be taken. While the price to earnings P ratio is a useful metric, it should never be the sole basis for stock selection. Relying solely on P ratios can lead to incomplete assessments. To make well-informed investment decisions, investors must consider a broader range of factors, including a company's financial health, industry dynamics, competitive positioning, management quality, and the prevailing macroeconomic environment. This comprehensive approach helps mitigate risks associated with a narrow focus on PV ratios. In summary, the P ratio is a valuable tool for evaluating a stock's relative value and growth potential, but it should be used in conjunction with other financial metrics and thorough research for effective stock selection. Thanks for watching. Enjoy the learning, and don't forget to like and subscribe.